This video tutorial will take us through some of the commonly used financial statement ratios that we have learned so far in Accounting 1030 and now in Accounting 1040. Aside from understanding the accounting equation and being able to read financial statements, your ability to calculate and interpret financial ratios is going to be one of the greatest strengths you gain from your introductory accounting courses. At some point in the future, you could be the external user of a set of financial statements as an investor, or an internal user of a set of financial statements as an owner, and you will go through the process of calculating these financial ratios. In general, financial statement ratios are used internally for a year-to-year comparison, or if available, to compare your business to that of your competitors or an industry standard. To go through some of the ratios, we are going to look at exercise 9-14 from volume 1 of the current textbook. Here we have Vision Electronics, which makes DVD players, and we have pulled out some of the financial information from their February 2020 financial statements. Not all of the financial information is given, only that information needed to calculate the financial statement ratios. The first ratio that we're going to look at is the acid test ratio, which is similar to the current ratio, but a more stringent measure of the ability to pay our current liabilities. The asset test ratio tells us whether the entity could pay all its current liabilities if they came due immediately. So the asset test ratio, we are looking at what cash can we get in our pocket today. The asset test ratio generally does not include current assets of prepaids and inventory. In general, a prepaid is specific to the business and cannot be easily liquidated to cash. In general, inventory is specific to a business as well, and one may not have a market for quick sell. And secondly, if we sell our inventory, we have nothing left to go on with active business operations. So looking at the asset test ratio, we pull from the financial information cash plus short-term investments plus net current receivables divided by our total current liabilities. This gives us a ratio in this example of 0.78. This is considered fair. In general, the higher the asset test ratio, the better able the business is to pay its current liabilities. In general, an asset test ratio of 1.0 is considered safe. However, the answer depends on the industry. The second ratio we'll look at is the days sales and average receivables. First, we have to calculate what the 1 day sales is. We take our net sales revenue and divide it by 365 because there's 365 days in the year. Our net sales revenue is our total sales less our returns, discounts, and allowances. In this example, we take our net sales revenue of $7,720 divided by 365, which gives us $21.15 per day. We then calculate the days sales and average receivables. We take our average net accounts receivable divided by 1 day sales. The 1 day sales we calculated above. Average net accounts receivable is the average between our opening and closing accounts receivable. So we're looking at what was our opening accounts receivable at the beginning of 2020, what was the ending accounts receivable at the end of 2020, which gives us 17.5 days. This collection period tells us how many days it takes to collect the average level of receivables. The shorter the collection period, the more quickly the organization has cash to pay for its own operations. The longer the collection period, the less cash that is available to pay bills and used for investing activities. Our results in this question give us 17.5 days. In general, 17 to 18 days in average receivables is a very good measure in relative to our 30-day credit terms. But we would have to compare this to previous years to see if we had remained consistent or if there had been a change in our day sales and average receivables. If we were an investor, we would want to see the comparative ratio from 19 to 20 to form a true conclusion. The current ratio, this is our total current assets divided by our total current liabilities. In this example, we are using total current assets of cash, accounts receivable, inventory, short-term investments, and other current assets. In this example, we are using current liabilities of accounts payable and other current liabilities. This gives us, in this example, a result of 1.05. We normally want this ratio to be above 1.0. This ratio measures the ability of our business to pay its short-term obligations. It measures the company's ability to pay current liabilities with current assets. We prefer a high ratio. The higher, the greater the cushion that we have to meet our current liabilities. The current ratio is a commonly used ratio used by lending institutions as an evaluation of how well a business is doing, and is sometimes a covenant of borrowing. The debt ratio takes our total liabilities and divides it by our total assets. The debt ratio indicates the proportion of a company's assets that are financed with debt, as opposed to the proportion financed by the owners of the company or business. This ratio, the debt ratio, measures a company's ability to pay both current and long-term debts or liabilities. A lower debt ratio is safer. The textbook explains that as a rule of thumb, the debt ratio below 60% is considered safe for most businesses. Here we take our total liabilities, which I've indicated in blue, which is our accounts payable, other current liabilities, and long-term liabilities, divided by our total assets, which was all of our current assets, which we used above, plus our long-term assets, which gives us a ratio of 0.7. Here, we are given the notation that investors and lenders get nervous when the debt ratio exceeds 0.5. So Vision's ratio of 0.7 seems high. It's above the 0.6 safe threshold that the textbook indicates. In general, if you were to go to the bank to borrow funds to support your business, a bank will lend to you up to a debt ratio of 0.75, with the intent that over time that debt ratio goes down as we pay down our long-term debts. The gross margin percentage. This measures the percentage of profit from our core sales of our business. For every dollar of sales, the gross margin indicates the amount of profits left over to pay all other expenses of the business. Internally for a business, a gross profit should stay consistent or increase over time. Sudden fluctuations of a gross margin could indicate that inventory is not valued correctly. In order to calculate our gross margin, we need to take our net sales less our cost of goods sold. So the 7720 minus the 4800 divided by the net sales revenue. We would compare this to our prior year percentages or to that of the industry standards to draw a true comparison. So in this example, we get 38%. So what this tells us is that for every dollar of net sales, we have 38 cents to contribute towards covering all of the other expenses for the business for that year. The rate of inventory turnover is calculated as our cost of goods sold divided by our average inventory. So our cost of goods sold, we take from the financial information. Average inventory, that is the average of our opening of 320 and our closing of 380. And this gives us 13.71 times. So what this tells us is that over the course of 12 months, we have turned our inventory over 13.71 times. This is another ratio that we'll look at and compare ourselves to how did we do last year or the year before. How do we compare to other businesses in the same industry? In general, we strive to sell our inventory as fast as we can because there's a cost of carrying inventory. Anything we purchase from our vendors, we need to pay for. So the sooner we can sell it, the sooner we have cash to meet those obligations. The longer inventory is held, the greater there is for the opportunity, the greater the opportunity there is for inventory to be damaged, become obsolete, or to be stolen. This inventory turnover is going to vary from industry to industry as well. If you look at, say, a local Zehrs store, a grocery store, they're going to turn their inventory over a lot quicker than, say, a Ford dealership that sells autos. We have to keep in mind, though, that an extremely high inventory turnover can lead to inventory shortages. Thus, we need to plan for the turnaround time from our suppliers. So if our current rate of inventory turnover is, say, 12, so once every 30 days, but yet it takes 6 weeks to get merchandise shipped from our suppliers, we need to be conscious of that, and we need to then, in our ordering process, order more inventory so that we don't run out to meet the needs of the customer. As noted, these ratios in general are used to compare ourselves from year to year internally, but also that same measure is used externally by the users of our financial statements. So those external users, such as lenders, possible investors, are going to put huge reliance on these ratios. Another reason to support why all of the information that's disclosed in our financial statements needs to be complete and timely for the year end or period end in which we're calculating the data. For your review of these financial ratios, the asset test ratio and the days sales and average receivables is part of our current Chapter 9 material. The other ratios were discussed in your Accounting 1030 class, so please review that from your earlier textbook.